Hey everybody, good to be here today. This is Brent Moores here, sitting in for Mr. James Boyd, who's out this morning. But I'm glad to be filling in for James. We're talking about trading the trend, and today I want to talk about some choices you have in trend trading. Sometimes we trade options, sometimes we trade stocks, but even within the options realm, there are different choices. You can certainly do long calls or long puts is one way to attack a trend, so to speak. Another is you can do vertical spreads. And what are some of the pros and cons of doing verticals versus just doing a long call, for example? And so that's what I want to hit up next. But let me just mention I have John McNichol in the chat helping me out. Always appreciate John. I've worked with John many years, and he's very knowledgeable on the subject today. So as you have questions between John and myself, we'll do our best to help you out. And we see some familiar names in the chat. Glad to have you there as well. You can follow us on X at Brent Moores CS, at John McNichol CS. And let me hit the disclosures real quick, and then we'll get to the subject at hand. Options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only and should not be considered an individual recommendation of any security, chart pattern, or investment strategy. We will talk about technical analysis, but just realize there's more than one way to do things, and Schwab does not recommend technical analysis as a sole means of investment research. A paper money application is for educational purposes only. For the sake of simplicity, I may not factor in commissions in these example trades that we do, but to keep in mind that is a factor. And realize that these are all example trades. They're not recommendations. All investing involves risk, including loss of principal. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And past performance is no guarantee of future results. Okay? Hey, great. Glad you're here. Let me pull up the Thinkorswim desktop software. I've got the S&P 500, and let me just kind of orient ourselves because I want to talk. This is about trend trading. So the examples that we use, I'm going to try and focus on trending stocks. And for the market, most part, if you go through most stocks right now, more than most are trending up right now. But you can find some downtrenders as well. And what I'm going to say really applies to both uptrending or downtrending. And when we start talking about vertical spreads, the same principles I teach can be applied to vertical spread, to like a swing trade as a trend trade. But here's the market. On my charts, by the way, I have a 20 and a 50-day moving average. 50's in blue, 20's in red. You could use something shorter term. Here's a 10 and a 30. Okay, same principle. If the stock is above your moving averages and your moving averages are sloping up, I think that's a pretty good way of kind of just quickly identifying a trend. Okay, that's my take. There's different ways to look at trends. Similarly, if a stock is going down and it's below the moving averages and the moving averages are declining, then I'm going to call that a downtrend. And if it's somewhere in between, if it's going sideways, often those moving averages will be going flat. Stock may be above one, below the other. Then the trend is much more iffy at that point. Okay, so that's kind of how I'm going to be looking at trends here today. But so just 20-day, 50-day moving average, that's what I'm using here. Now, of course, you can buy a stock. You can, and let me give you an example here. I'm going to start off with Microsoft as an example. It's a company everybody knows. It's one that I'm going to call in an upward trend. We had this gap on earnings. Okay, fine. And then, a lot of times after a gap on earnings, you expect it to pull back a little bit. Not in this case. In fact, that gap, when you have a gap like that and it takes off, we'd probably consider that kind of a new support level for this stock. But this has been going up and going up at a reasonable pace. And for a lot of technical traders, they may expect it to continue to go up. I have no guarantees on that. But we could buy the stock. We could do a long call. And there's great things about doing long calls. There's downsides to long calls as well. They're more leveraged than just buying the stock. if the stock goes down, if this stock went from 460, let's say we did an at the money long call and the stock went from 460 down to, let's say it drops 10% in price from 460 to about 410, 420, you're very likely going to lose almost all that is that entirety of the long call in that case. Whereas in the stock, it's like a 10% drop. So that's one of the pros and cons. But why would you consider, I want to propose to you today an alternative, and that is doing a long vertical instead of a long call. Okay. And so I want to just kind of write out initially, and we'll get down to looking at the specifics of the trade here in a minute, but some attributes of long verticals versus just like a long call, just doing a long call. All right. So number one, you can cut the risk of the trade because on a long vertical, let's just say a long call vertical, but what I'm going to say applies to long put verticals as well. But in the case of a long call vertical, you're going to do a long call, which is going to cost a certain amount of money. And then you're going to sell a call, which is going to bring in a little bit of a credit. Now, net, it's going to cost you money, but it will reduce that cost. And because the initial cost is the risk on the trade, therefore, we're cutting the risk on that trade. So that's an advantage of long verticals over just doing a long call. Okay? And that what goes along with that is you're going to, you limit the gains. Okay? You limit the gains as well. So if I sell a call, if I buy a call, again, long call, and I sell a call, basically, once the stock kind of hits where that short call is, typically a higher strike price, that is going to, that's where we're limiting our gains out there. Okay. So, pros and cons. There's more pros and cons here, but that's kind of the thing with spreads. You cut your gains, but you also cut your risk too. And that's the deal, and it may be worth it to you. Now, in the class webcast earlier today, Cam was talking about long verticals. And in fact, Josh, who's in the chat, hello, Josh, mentioned something about what about, legging in at different times to these. Can you do that? Absolutely, you can do that. You could buy that call, okay? You could buy that call if you wanted to, and then and not sell the call initially, and then hopefully the stock goes up, you're bullish on it, and then sell the call later. And if the stock has gone up and you sell that call later, you're bringing in an even bigger credit there on that. Okay, so there we go. So question on, can you do a short vertical? You can do a short vertical. I'm focusing on long verticals right now, but the cutting risk, limiting gains, that is true. Both of those are true for short verticals as well as long verticals, but that's just outside of what I'm doing in there. Okay, and so. But let's see. It also affects other things. Okay, so you're going to reduce the delta. Okay, let's say you're doing a long call and you do it at the money. Our delta in that case is going to be probably somewhere in the ballpark of 50 delta on that. Okay, but if I'm selling a call at a higher strike, my plus 50 delta, I may also have a negative, 30 delta. These are just rough estimates on there. We'll look at them there. And therefore, my net delta on this is going to be maybe plus 20-ish or something like that. What does that mean for the trade? It means it's going to slow down the trade. Well, ideally, you don't want to slow trade if the stock is going your way, but if the stock is going against you, you do want to slow things down. So That's what a reduced delta does. It means the profits or losses that you see are going to be at a reduced rate. It just kind of makes everything more in slow motion there with that long vertical. Here's another thing it does, as opposed to just doing versus just a single long option, it lowers it lowers your theta. Remember, with just a long call, your theta is going to be working against you. Okay, long call, long put, theta works against you on those. It still is going to be a net against you probably, but it's going to reduce that level there. So those are just kind of pros and cons on those. Let me just say one more thing on this limit gains. When you look at a long call, what's the max gain? We call that MG. What's the max gain on that long call? Well, if you look at it on Thinkorswim, it's going to say something like infinite or unlimited or something like that. Well, that sounds great, but how many of you have had an infinite gain on your portfolio? Even a ridiculously big gain doesn't occur that often. So often what we consider to be like, ooh, these outsized gains that are possible, more often than not, they just don't happen. And therefore, limiting your gains, yes, that is a real downside, but maybe that's not the end of the world, because if we limit our gains to what's more of a reasonable area of where we think the stock is going to go, then maybe this isn't that big a downside, and some of the other pros to it, such as cutting the risk and lowering your theta, may be worth it. Okay? All right. So there we go. So let's continue with our example on Microsoft here, because Microsoft has been going up. It was at 450, 460, and now we're up at 468. So it's making its way up. The underlying assumption here is that it's going to continue. Okay, it's going to continue up, and so you just never know if it is going to be, but if it's going to continue up. But that's true for technical analysis, by the way. In general, we look at past data, like in the past the stock bounced off a certain level. We call that a resistance level or a support level. Therefore, we kind of assume that in the future it's going to do the same thing. Often it doesn't, but that's kind of the underlying assumption of technical analysis. We know there's no guarantees. The trend in the past has gone up. We're going to assume it's going to continue. We know at some point it's not going to continue, but that's how we're going to do. Okay, so trends up. We're going to expect it to go up. Now, can you see it go up to 480? Yeah, I can see that going up to 480, no doubt. That doesn't seem like that big a stretch. What about 500? Is it going to go up to 500? Well, that's off the chart right now. Let me change my scale. That's probably a little bit of a stretch in the near term, going to 500. It can certainly happen, but that is where we're, so I'm going to say I'm willing to give up some of that extra gain in order to reap the benefits. So let's look at an example. The stock right now is at 460, we'll say 467 here, okay? So I'm going to go to the trade tab, and I'm going to do something that's just kind of at the money, and we'll call that 467, 465 is at the money. Okay, so if I just do a long call, it's going to cost me about 14 bucks, roughly. That's great. Now, my theta, losing about 16 cents a day, or $16 for the full contract. It's a more expensive option. My delta, about 57. What if we do a 465, 480 call, long vertical? So let's go 1, 2, 3 strikes apart. So I'm going to go deep and wide, 1 month, 3 strikes apart. 465, 480. This is what we're looking at right here, okay? So let me do this. 465, 480. This is the proposed contract. And how much is the cost? Roughly 780. That cut that, what was it before? It was $17, I think. Am I right on that? It cut it way, way, way down in terms of the cost on that. My theta, about 3 cents. It knocked it down to the point that it's probably not that big a factor at this point, the theta. And my delta, down instead of 57, I think it was, it's down to about 20. So that's the slowness of the trade when we do that. So if I click here, let me get out of this. Let me go 465, 480. I'm just going to click on this trade and I'm going to confirm and send. Max profit, $732. And if I were to, let me get out of this. If I were to analyze this trade, let me just analyze this. Here's our risk profile on this trade. Notice at expiration, okay, at expiration, our max gain about 480. Okay, that's where that's exactly where the max gain is at expiration. That's according to this risk profile. So that's the max theoretical gain is right there. Now, we don't know what individual pricing of options will be there. When I say 465, 480, everybody, I'm saying we're buying the 465 call, we're selling the 480 call. The one we're selling represents our max gain where it flattens out there. Let me go back to that trade tab. Let me go back down here. I'm going to change this back to single. And 465. Yeah, I said it's about, instead of, is it going to let me do this? Hold on. Instead of the $14 cost, or that'd be $1,400 for the long call, my risk is not quite, but almost cut in half on that. Not quite, but almost cut in half on that. That's a good thing because we need to be risk conscious on our trade. Am I willing to give up my potential gains above the 480? If the answer is yes, then I may consider this trade, okay? Then I may consider this trade. Now, Art said, this is a lower probability trade. I'd rather do a short put vertical that's in the money. Yes, this is a low probability trade. Anytime you do, and I'm kind of comparing long calls versus long call verticals and long puts and long put verticals. Anytime you do a long option, long call, long put, that is a low probability trade right there. What's the benefit of it? The benefit of doing this is this, okay? I'm not saying right or wrong. I'm just saying you got to be aware of the pros and cons of this trade. Max profit, max loss, roughly equal on this, okay, doing this trade. Short put vertical, if you're doing them and make them high probability and you do those out of the money, you're not going to get, your reward to risk ratio is probably going to be in the range of 0.3 or 0.35 or 0.4, something like that, instead of roughly 1-to-1. So there's definitely pros and cons to that. No problems, Art. That's clearly an alternative for you to do on that. All right. So we can do that. And if we want, we can just say, look, if this goes against me, I'm just going to get out. Like, I think we probably we're bouncing off here. This is probably a support level. It's near my 20-day moving average. We kind of skimmed off this level in the past. If I break down below 455, I'm going to get out. Okay. I'm going to get out. And therefore, we're going to assume this is trending up. Okay. We're going to assume this trend is going to continue on this. All right. So there we go. And so 455, let me just jot that down before I forget that. 455. There we go. Naresh says, hey, we could alter this trade And we could do a 465, 470, but do more contracts. Well, let's consider that, because this is what I want. I want you to think about this here. There are definitely pros and cons to whatever we do here on this. If we do a 465, 470, okay, that we're saying, well, reward to risk ratio may go up. In this case, the 470 would be our peak on this. Okay, so let me just let's I want to explore that further, because I think it's a good point. I want to put in this trade, and then I want to look at that. Okay, so I think it's valid. Let me just click on confirm and send, and I'm going to write down three things. Okay, I'm going to write down three things. My break-even price. Break-even price. And these are three things you should always consider on these trades. 472.70, okay? My max gain, okay, is 730. My max loss is 770, okay? So here we go. And I'm gonna put this in a long verticals bucket there. We'll send that. Now, let's look at an alternative trade. Let's instead look at 465, 470. 465 long call, I'm going to click on that contract. 470 short call, I'm going to hold down my control key and put this down. Okay. Now let's do our same deal. Now, the suggestion was we can do more contracts of this. So the numbers are going to be lower on this, but really that's not the issue. That's fine, because we can just do more contracts. Max profit is 202. Max loss is 298. And my break-even stock price is 460. It's 460. We'll say 468. Okay, 468. All right, so by doing it this way, my break even is a little bit lower. It's down at 468 instead of 472. Okay, so that does, I think objectively, that just improves the trade there on there. Good point on that. Max profit, max loss. Let me just do my reward to risk ratio on the other one. It was max gain, 730 divided by 770 is 95% return on risk. This one is going to be, to do my reward to risk, I'm just going to divide my max profit by my max loss. It's 202 divided by 298, okay? And that's about a 68%, okay? Return on risk, 68%. Okay, so there's your pros and cons on that trade. I want you to think through these, and I appreciate you, Naresh, for mentioning that, because you always have a choice, okay? You always have a choice on these trades. In this case, our break even is better. Our return on risk is just a little bit worse. Maybe, perhaps, you just need to decide for yourself which one you want to do there, okay? And let's go, and let me get out of this trade. I'm not going to do both of them right now. Let me get out of my drawing tools, close this out. We already did that other trade. I'm going to delete this. Okay. So here's what I'm saying on this. This level here is we're calling that a support level. This is a trend trade though. Okay, this is a trend. We're expecting this just to kind of continue to trend up for a while. I don't know how long. It could continue to go up for a year. This isn't going to be, this trade was I think my expiration was 43 days out. So that's one of the things of options. It limits how long you can be in that trade as soon as you do an option there. So I'm hoping that's making sense, everybody. You can, now, when would you just do a long call versus that long call vertical? Well, if you just think this is going to continue to go way up. Instead of kind of capping our gains up here, if I think this is likely to go up in this range here in the next month or so, then you would just do the long call, okay? If I think this stock is just going to continue to trend up for months and months, probably just do long stock would be a possibility. There's always pros and cons. Now, let's reverse this a little bit and let's just do, let's look at one on the downside, okay? Because there are, not every stock is going up right now. Here's TMO. I'm going to call this guy a downward trend. Okay, I'm going to call this a downward trend. Why? I'm below my moving averages. My moving averages are sloping down. That's kind of number one. Number two, I can just kind of do this with my trend and see, well, that's kind of what's happening here. Number three, let me just adjust my scale a little bit here. I got to decide how much it's going to go down. If I think it's likely to hit, 350 soon, likely, I would just probably do a long put, okay? Just a long put in this case. But if I think, maybe somewhere in here is a more realistic target price on that. Oh, I was supposed to put a lot. Okay, see ya. Thank you very much. I forgot to put in that exit trade on there. We'll do that in just a sec. Okay. Thank you for the reminder on that. I got a little sidetracked on that. Okay. So if I think this is the target down here, a more realistic target, then I may, instead of doing that long put, I may consider doing that long put vertical. Remember, there's going to be pros and cons. The pros and cons are going to be the same ones we mentioned before when we were doing that call, talking about calls. We're going to cut the risk down. We're going to limit the gains. Okay. We're going to limit the gains. It's going to reduce the delta, and it's going to lower the theta. Okay. Remember, those are the pros and cons there. Okay. Now let me just go back. We did the this Microsoft trade. We just did this. Okay. I forgot to put in that exit point. We said we were going to exit out at 455. Well, let's do it. Sometimes you may want to put in the exit after you enter the initial trade. You can still do it. I'm going to highlight it on my monitor tab under my position statement, and I'm going to right click on it. And it gives me choices. It says create closing order. Now, it doesn't know whether I want to get out of the 465 call, the 480 call, or both. Well, this is going to be a trade to get out of both. So I'm just going to select this. Okay, here's my order to exit. I'm going to make it a market order. I'm going to make it good till canceled. I'm going to click on the gear, and on that gear, it brings up a window. I'm going to go right down here to where it says symbol. I'm just going to click on it, and it automatically fills in Microsoft. We're going to say marks less than or equal to. Remember I don't know what grade. What grade is it when you go through that, the alligator wants to eat the bigger thing there? That is a less than or equal to, and we said I wrote it down. 465, I think. Got to read my writing here. Where did I put that down? I'm not sure. No, it was 455. 455. Okay. 455. There we go. So click on save. And now I'm going to add this in. I'm going to send this order. Make sure you read the red little marks here. When we put in closing trades, though, this is for the closing trade. These numbers right here really aren't going to make a lot of sense right now, putting this in as closing trade. It is assuming this would be just like a short vertical, okay? So I'm going to send that order. I'm going to go back here, and hopefully it does. Right there, you can see now we have buy and sell on there, okay? let's go back to where we were. We were looking at TMO. Okay, we were looking at a potential bearish trade. We said, look, if it's going to go down a long, long ways, probably not going to. We wouldn't do a long. We may just consider do a long put instead of a long put vertical. But in this case, I'm going to say if we get down to maybe down here, about 380 or so, or 375, that is a reasonable expectation over the next month or so as the stock continues its, assuming it continues its kind of rate of descent. Now, hey, look, it certainly could happen that we have a period like this where it just takes this big drop. Okay. And in that case, you're still making money if it does that. You're just not making as much as you would otherwise. There's always pros and cons. Let's go to TMO. And I'm going to go out here. Now, one thing you may consider is you can go and you can look at, say, weeklies. Okay. On some stocks, it's probably not a problem. On some stocks, and I think TMO is going to be one of them, Thermo Fisher Scientific, is you start to have more liquidity issues on this. So the stock's around 401. If I want to buy something that's near the money, say 410 or 400. Look, if I just bought that 410 put, it would cost me almost $2,700. $2,700. If instead I do that 410 and then I sell one, it's going to cut into the cost there. Or if I do a 480 put, it's going to cost me about $2,500. Did I say 480? I meant 405 put. It's going to cost me about almost $2,500. Any contract I sell, that is a credit that is going to help to offset some of that debit there. Okay. So there's that. But here's the problem with these contracts right now. Look at the bid price and the ask price on those. Do you see how far apart those are? Okay. Even when I go at the money, let's see, stock's right at 400. So we're going to say, even going at the money, that's a huge spread. I mean, that's a 25% difference between those prices, bid price and ask price. That is going to be, you're going to find that much more common on these weekly contracts here. And so if you go to monthly contracts, hopefully, we end up with something that looks a little bit better. Let's go back to that $400 strike. 1680, and so instead of a $4 difference or something between those, there's about a 40-cent difference between those. That makes a huge difference on those. So we could do the same thing. If I go 410, by that, delta was 55, theta about 18. If I click on this, what's my new delta going to be? My new delta is going to be, instead of the 55, assuming I were to sell the 380, it's going to be the difference between those. Well, that's 26 cent difference. So our or 26 delta difference. So our net delta here on this trade is going to be 26. Okay? A little bit slower moving. My net theta, theta 18. There's probably there's probably a rounding error here. We're probably going to have some negative theta, even though these basically cancel each other out. The point is that's going to reduce that theta. So one of the biggest challenges with long calls or long puts is time decay wearing against the trade. In this case, it may not entirely get rid of that, but it's going to drastically reduce that problem there for you. The cost is if the stock goes down, it's an opportunity cost. If the stock goes down below, say, that 380 a long ways, you may be kicking yourself and saying, I could have made a lot more on that. So therefore, let me go and I'm going to do, I'll do the 410, okay? 410, I'm going to hold down my control key. I'm going to click on the bid price, and there's our trade. Let's confirm and send. Remember, on any of these trades, consider where's your break even. Okay? Break even is just a smidge below where the current stock price. Current stock price below is at 400. Here we're about 397. Okay, break even. What's your max profit? And what's your max loss? Our reward to risk ratio on this one, because of the strikes I chose, actually isn't that bad. Max profit, 1735 divided by max loss, 1265. That's about 137%. Okay. Reward to risk. Okay. Reward to risk. If you want a higher probability trade, we can adjust the strike prices. You may consider something like a short call vertical. If you want to be more aggressive, you could move the lower strike down. Instead of a 380 short strike, maybe you do a 370 short strike. That gives you more, it would increase the max profit, but it's also going to increase the max loss there as well. Okay. And your reward to risk ratio probably isn't going to be as good there. Well, actually, your reward to risk ratio may be as good, but your break even prices will adjust. So you can always tweak these prices here just to see what makes sense there. Okay. Let's go. And I'm not going to send this quite yet. Okay. What about exits on this? Well, I'm going to put in an exit here, and I'm going to say, look, we're planning on this bouncing down. I'm going to call this kind of a resistance level right around there, around 413. If the stock breaks above here, at that point, I've broken my 20-day moving average, I've broken my horizontal and my diagonal resistance level. At that point, what time? We said that was about 4:15. Then we may just call that one quit. Call quits on that one there. Okay. Now, Sia said, that's a pretty wide spread. Absolutely. We did do a pretty big spread. Remember, you can do this, you can do narrow spreads, you can do wide spreads. The bottom price, in the case of we're talking long put verticals here, okay? The bottom price, the one you're selling, is going to be the one where you think realistically there's a decent chance it's going to get to. Yes, if there's a chance this could go down to $300 for all I know tomorrow, but realistically it seems pretty unlikely. Therefore, and if you go too far down, you're just not bringing in much of a credit there on that. Same with the upper strike. Where's the upper strike? Well, the upper strike is going to be the area where you think it's unlikely to go above, okay? Because that represents at expiration your max loss. In this case, we're also going to put in that stop order on this, okay? So our stop order is, we said if the stock breaks above, what was that, 415, okay, 415. So let me go back to my trade. This one I'm not going to forget to put in initially. The last one I had to put it in after as an addendum. Yes, this is a bearish play, folks. This is a long put vertical. This is a bearish play. Look, if you didn't hear me say that, you should be able to look at this and think, well, that's a really, this would be an odd, for a trend trade, this would be a very odd bullish trade because this is trending down. This class is all about trend trades. This class is trending, this stock is trending down, so it is a bearish trade. Okay, so I got my entry order. I'm going to right click on this. I'm just going to create a first trigger sequential order. I'm going to right click on it, and I'm going to create an opposite order. The contracts that I'm selling to get in, are then, I'm going to buy to get out and vice versa. And I'm going to make this a market order. I'm going to make it a good till canceled order. I'm going to click on my gear again. And we said we're going to get out if TMO marks greater than or equal to. So I got to switch this. Okay. Greater than or equal to 415 was the price, if I'm remembering that correctly. Okay. So 415, 415, and save. Okay. And I'm going to confirm and send. And I'm going to put this in long verticals. And we're going to send that order there. Okay. All right. All right. So Vic said, could we have done a bearish short call vertical? Absolutely, we could have. I'm not going to take the time to go through the whole thing, but let's say we thought, I want this to be a higher probability trade. Could I have done we'll say a 420 and sell the 420 call and buy the 430 call? If I did that, that would be about a 290 credit. If I did that, my max loss, $10 minus the 290 would be 710. Okay. And all we would need to do, we want the stock to stay below 420 in that case. That'd be a much higher probability trade, wouldn't it? Yeah, absolutely. Reward to risk ratio, not nearly as good. That'd be about 290 divided by 710. That'd be about a 40% return on risk ratio. Okay. So those of you who are wondering, like, out of the money short call vertical versus doing the long put vertical, much higher probability trade if we did that short call vertical. Our reward to risk would not be as good. In this case, I'm assuming the short, put it this way, the short call vertical would be much better if the stock just kind of goes sideways. Here, I'm assuming a continuation of that downtrend. Okay? I'm assuming a continuation of that downtrend. All right, folks. I think we're going to call it there. Let me just mention a few things. James should be back next week in this webcast, number one. Number two, thank you, John, for helping me in the chat. Appreciate that. Coming up next, we have short verticals. Connie Hill teaches that class. So check that class out, short verticals. Okay, it kind of complements what we went through here today with long verticals. And I want to thank each of you for taking some time joining me today. Hope you all have a wonderful rest of the day, and we'll see you later. Bye-bye, everybody.